This is David Ranson. Welcome to our webcast updating the state of the capital markets and the economy for September 2020. And the title is Output and Capital Markets Returning to the Status Quo. And the highlights are these. Forecasters generally fail to anticipate the speed of the rebound in national output and spending by a mile. Their bearishness spread via the press, and it is taking a long time to lift. The dip in output has been as brief as it was deep. In hindsight, a break in economic activity, and not at all like a conventional recession. But to adapt to panic-related shutdowns, the US economy was also forced to change its shape. The interruption afflicted heavy industry and a large part of the employed labour force, both of which lack resilience and are recovering more slowly. The performance gap between output and employment will further increase inequality and social upheaval. Despite that, the bull market in stocks is back with us. Financial market prices are returning to where they were as the year began. In its early weeks, the pandemic crisis brought with it many economic uncertainties, destroying widely shared expectations that growth would continue at the prevailing rate of 2 or 3%. After the national economy was shut down, second quarter GDP recorded the largest fall in history at an annualized rate of 32%. Few experts showed any faith in the resilience of the US economy at that point. Exhibit 1 shows the distribution of forecasts for the third quarter as reflected in a monthly survey of about 60 forecasters conducted by the Wall Street Journal. In April, the average forecast for Q3 was an annual rate of 6.2%, and the range of opinion was quite wide, as shown in the red bars. Then, as news came in, month by month, the pessimism was overtaken by events. The range of opinion, the blue bars, narrowed a lot, while the average forecast jumped to 24%. Professional opinion has rarely been repudiated as completely as it was during this rebound. We now know that the stock market provided a far more realistic picture of the economic threat from the pandemic than forecasters did. Exhibit 2 shows how the market fell as the national shutdown loomed, but the fall during the 2008-2009 recession was twice as deep. We can also see that the pandemic-related collapse was more sudden and more brief. Most important, the chart shows that the rebound from the sell-off was more vigorous and complete. It's now clear that comparisons made of the economic threat from the pandemic with the Great Recession of 2008 or 9 were greatly exaggerated. History tells us that unemployment does not return to normal quickly, even when the rebound in total output is strong and rapid. Growth in employment will be slow for a decade or more, as Exhibit 3 shows happened after 2008. That's partly because recovering businesses are eager to rehire their most productive and critical workers, but less motivated to bring the rest of the workforce back on board. There's also a disincentive on the other side of the labour market. Unemployment relief reduces the urgency with which the lower paid seek work. For both reasons, labour market recovery is slow. And when benefits end, some workers drop out of the labour force altogether. The scope for economic inequality and social upheaval is disturbing. Equity investment performance is on a track to produce a net positive return for 2020. Going forward, though, leadership may have passed to other asset classes, as we saw in recent setbacks. Exhibit 4 compares the rebound paths of the S&P with an index of C-grade corporate bonds. As always, the junk bond market is slower to come back than equities, but its rebound has been more consistent, and there's further upside ahead. Countries differ in their economic vulnerability and resilience to a crisis. The most resilient economies should be expected to be capable of the strongest market recoveries. Exhibit 5 makes it clear that the rebound in equity prices has been far from uniform across countries. China came out of the crisis relatively unscathed, and its market has rebounded so strongly that its performance year to date has been among the best. The other winners tend to be economies with the freest markets, including the US and Switzerland. Japan did not take as big a hit as the US, but has been left behind on the rebound side. The worst performer in this sample of countries is the UK, followed by Germany. The recent fall in the foreign exchange value of the dollar got much more attention than the rise that had taken place a few months earlier. But taken together, it's clear that one was simply the reversal of the other. As a safe haven among currencies, the dollar gained when the crisis arose, but has now returned roughly to its starting point. The inflation rate has gone through the same process in reverse. As the dollar gained, price indexes declined. Then, as the dollar fell back, price indexes reaccelerated. There are no convincing signs of sustained inflation in the 2020 experience. Tactical asset allocation opportunities normally relate to cyclical fluctuations in inflation or growth over a 1 to 2 year time frame. The leading indicators for anticipating the performance of major asset classes are shown in Exhibit 7. The price of gold is plotted horizontally and credit spreads vertically. We appear to find ourselves in the northeast quadrant that's associated with stagflation. But there's some uncertainty whether the gold price rise in the past year has been an inflation signal. Capital flowing out of risky assets pushes up the gold price even if inflationary pressures are absent. To corroborate the current gold price signal, we should turn to other leading indicators of inflation, such as the Consumer Price Index for goods and the Producer Price Index for commodities, and we saw those in the previous exhibit. On this occasion at least, these leading inflation indicators do not corroborate the gold price. And now I'd like to introduce my old friend and colleague Frank Kane, who will ask a number of questions relating to these matters, and I will try to address them with answers.
David, the Fed and the central banks of other developed economies have been expanding their balance sheets to backstop their economies. Support for frontline medical workers, small business loans, income support for individuals, and so forth have added up to trillions. My question is, where is all of the liquidity landing? And when are we going to see some effect on consumer prices or producer prices?
The Fed's balance sheet expansion and relief payments to the public affect the economy through different channels. Both have taken place on an unprecedented scale, but in neither case does the economy experience an increase of liquidity that would lead to higher prices. In the case of the Fed, these trillions of liquidity don't enter the economy directly, but add to the banking system's stock of reserves. If the banks don't change their behavior, this newly created money will remain irrelevantly on the sidelines of the economy, as indeed it did after 2008. I see just two situations in which banks change their behavior. In one, there's an increase in the demand for funds, to which banks respond by lending. But I can't see how the Fed's action would change the demand for funds. In the other, the Fed imposes additional regulation, as it did in 2008, which caused banks to become more cautious about lending than before. Government relief is a form of income that Milton Friedman classified as transitory. Back in the 1960s, he showed that the bulk of transitory income is saved rather than spent. That would include using newfound assets to pay down debt. So rather than build excessive cash balances, the recipients of government checks first deposit the funds in their bank accounts and either invest them or use them to reduce debt. The banks convert the income in cash into reserves. The net result is that the Treasury becomes more indebted while the private sector becomes less indebted.
I think the MMT folks would say that budget deficits and maybe Fed expansions don't matter, that they don't affect the strength of the dollar, inflation, or therefore interest rates and bond prices. Do you agree?
All these variables are all interrelated, and the empirical evidence needed to disentangle these relationships will never give unambiguous answers, so it's almost impossible to prove or disprove whether budget deficits or Fed balance sheet expansions matter. But there is one strong and sustained correlation that stands out between currency depreciation and inflation. History shows that inflation is always preceded or accompanied by a depreciation of the currency. No inflationary consequences can be expected from fiscal and monetary policies, including MMT, as long as they don't change the price of the dollar.
In some of your earlier research, you highlighted the impact of changes in the price of gold on stocks, bonds, and commodities. Gold has had a good run this year. What does that tell us about those other three asset classes for the remainder of 2020 and for 2021?
Historically, an advance in the price of gold implies an increase in inflation, and that would be bearish for stocks and bonds and bullish for commodities. The uncertainty here is whether the gold price increase could be attributable to unusual geopolitical events, such as confrontations with rogue nations or pandemic threats. That does seem to fit the experience of the last year or two. Thank you, Frank. And now the next client webcast will be in November, and we'll have a theme to be announced later. Thank you for participating, and I look forward to November.